The major U.S. banks are preparing for something big. I'll show you what they're doing and why it means they think an all-out financial crisis is imminent. And this may not make a whole lot of sense because just last week we got a blowout non-farm payroll report that showed that the U.S. labor market and economy were holding up against the tariffs. We also got the passage of the tax bill, and in response to that, the major U.S. investment banks came out and said that this is a catalyst to send stocks screaming even higher. And yet when you set all of this aside, it's not what the banks are saying, it's what they're doing that matters. And right now they're doing something they only do ahead of every major recession and financial crisis. And tonight's show is brought to you by Monetary Metals. If you're interested in earning a yield in gold, paid in gold, check out the links in the description and pinned comment below. Because I want to show you how the mainstream media is spinning this. I want you to see how they're reacting to what's going on in the markets right now. And then I'm going to show you the truth of why the banks are preparing for an all-out financial crisis. As short-dated treasuries outperform as U.S. tightens the screws on trade. And I want you to see here how the media is reacting to what they're seeing, and what they're finding out is bill yields continue to fall. We're even seeing some short-term note yields go down. And the problem here is they're all below the overnight federal funds rate. Now, the media thinks this has something to do with trade, but what they don't realize is this has everything to do with collateral. And it's not just the major U.S. banks that are buying up all these bills and notes. It's also foreign central banks and foreign investors. And what this is an indication of is that financial conditions are tightening, and in a major way. And the evidence is clear as we turn to two-year treasury yields, which fell as much as 3 basis points to 3.85%. 10-year yields rose, and the dollar is also up against most of its major peers. Now, what we saw in the bond market going into the passage of the tax bill was that yields went up. And this is a normal reaction. We see this every time there's uncertainty about a tax package, because what happens is the market starts to think that if the bill doesn't pass, that people aren't going to get paid on the bills that mature if the government should run out of money. Now, what happened immediately after it passed? Interest rates came crumbling down. Now, if the economy was poised to boom here, what we should see is interest rates rising. That's the normal reaction. So this is very perplexing to the media, but when you're about to see what I'm going to show you, it makes very clear sense. What's happening right now is the banks aren't just preparing for a recession, they're preparing for a crisis. Let's take a look at this next slide. We've got two-year treasury yields in blue against the overnight rate. That's the federal funds rate in red. And you can see going into the dot-com bubble, remember, stocks were screaming higher, and two-year treasury yields, they were breaking down. The Fed said, look, we need to raise rates, keep rates high. Two-year yields went down. You see the same thing happen going into the financial crisis. The Fed was on pause. The bond market says, no, things are getting worse, and then they got bad. We saw it happen going into the pandemic, and now we're seeing it happen again. We keep hearing from Fed speakers that they don't want to cut rates here. And yet, what did we hear from Treasury Secretary Scott Bessent last week? He said, look, the Fed's making a major policy mistake here because two-year treasury yields are telling them the overnight rate needs to go down. And this is all happening because the major banks want collateral right now. They're very concerned about the state of the economy, and the bond market's giving us a very clear sign that things are about to get worse. When that happens, banks don't want to rely on anything but the actual collateral they're holding. That's why they're paying to drive rates down right now, is because there's a shortage of collateral. They want to get their hands on it, and in a big way. And uncertainty has increased ahead of the July 9 trade deal as deadline, as investors are starting to gradually price in the risk that President Trump could once again escalate global trade tensions and thus deal a blow to the global economic outlook. So again, you turn to the media, and what are they saying here very clearly? Well, this decline in yields has everything to do with the trade war and some uncertainty that just seemingly days ago went away and helped propel stocks to a new all-time high. But the reality is, when we go back and look at that chart, bill yields have been coming down. And what have we seen in two-year yields? They've been coming down as well. This is not a recent event. This is a sign that financial conditions are tightening, and in a major way. And again, anytime you see an economy start to run out of money, this is exactly the response you see in the bond market and from the banks. Again, they don't want to be caught in the middle of a crisis without collateral. They got caught that time in the financial crisis. They don't want to do it again. And that's one of the reasons they're buying here. But let me give you the details. It's going to blow you away what you're about to see. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. There are risks to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to Monetary Metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through Monetary Metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. Because when we look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes and compare it against 2-year treasuries, we start to get a picture of what's going on in the financial system. Now, when you see that the percentage of banks tightening standards, that line is in blue, and anytime it's over the horizontal black line, that means on net they're tightening. On the way up, they're tightening at a faster rate. On the way down, they're tightening at a slower rate. And I want you to see what happens when they tighten. You can see 2-year treasuries rose and then they came crashing down. You can see the same thing happen during the financial crisis, happened before the pandemic. And right now you can see 2-year treasuries have been on a decline. At the same time, banks have started tightening lending standards again. And based on the trajectory of yields, what it indicates is that banks are going to further tighten standards, and that's going to constrict the creation of credit. Now, I want you to understand the importance of this because in a debt-based economy, the commercial banks create money through the origination of a new loan. Now, that new money does 2 important things. 1, it pays on existing debts. Number 2, it gets spent into the real economy, and that leads to growth. So the problem is when banks start constricting the creation of credit, it means we're seeing financial conditions tighten. The risk is there isn't enough money to sustain growth or to pay on all the debts. And that is the seeds to the next financial crisis. In response to that, rather than go out and lend more money, the banks who are worried about getting their money back as the economy slows, they start holding collateral to insure against the next crisis. And we can see the evidence of exactly what I'm saying happens. Let's take a look at the net percentage of domestic banks tightening standards for commercial and industrial loans against the creation of loans. That is commercial and industrial loans shown in red. That is the weekly data. And you can see as banks tighten standards, they constrict the creation of credit. And you can see the deceleration in commercial loans and the eventual contraction as they fall below that horizontal black line. You see it happen during the financial crisis. And if you start to wonder why things get worse, why we have recessions and financial crises, has everything to do with the banking system. When you start to understand that as money is paid off, as a loan gets paid down, that money is removed from the economy. And that's the problem here, because during crises, you see things get defaulted. You see people paying down loans. You don't see the banks creating new money in the economy. And what we're seeing right now is banks tighten financial conditions. What it means is the new loans, what we're seeing is just hovering above the zero bar right now, is likely to roll over and head down, and that is a major warning sign for the economy. Because now when we overlay the delinquency rate, what it suggests is there isn't going to be enough money to sustain economic growth, and there certainly isn't going to be enough money to pay on all the debts. And you can see the very clear signs here going back to the late 1990s as the banks tightened lending standards. And what do we see is the delinquency rate for all consumer loans shown in red, that headed higher. You see it happen right here again during the financial crisis, and it started to happen right around 2023 as the delinquency rate went up, and that what it means is it's likely to go even higher. So it's very interesting that the banks see a financial crisis coming, and in response to it, they're the ones that are going to make it even worse. But what is it they're looking at? Because again, the non-farm payroll report suggested that everything was okay. Well, perhaps it's not as okay as the report suggested. Let's turn to the Conference Board's Employment Trends Index, and what did they say today? Well, what it underscored is that the U.S. labor market remains stable. Well, maybe not for long, but what they noted was through ongoing uncertainty, this is continuing to temper consumer and business confidence. What they validated by their report is that everything was fine, that the non-farm payroll report was on point. But when you look at this chart that shows the Conference Board Employment Trends Index in blue, it's a non-farm payroll report in red, you see this massive gap and this massive deviation. And you can note throughout history that where the Conference Board's Employment Trends Index goes, you can see the non-farm payroll report follows. But right now, the non-farm payroll report isn't following, suggesting that perhaps the labor market is far weaker than the payroll report wanted to suggest. And there's some evidence based on what we're seeing in the bond market that, again, financial conditions are tightening. It's not just the banks. It's going to impact the broad economy and the labor market. And when you start to understand that, it makes sense. Why are banks tightening standards? They don't want to lend. They're prioritizing getting their money back right now. And what is the bond market telling us? That the labor market is about to unwind. Here you can see the yield on 2-year treasuries in blue heading lower, and against that is continued unemployment claims in red. So as financial conditions tighten and bill yields go down, you can see continued claims go higher. You see that happen in every cycle, and this one is going to be no different. As yields go down, the likely outcome is we're going to see more Americans on the unemployment line. Now, the question you might be having is, why do yields go down? It's because, again, the economy needs the creation of new money. So if there is a constriction in that by the banks, what is a natural response by yields? Not to go higher, but to go lower to encourage lending. Again, the problem is, it doesn't matter how low they go, the banks aren't eager to lend here, and the Fed not eager to follow suit. Well, at least not yet. But even though we're seeing bill yields go lower and 2-year treasuries yields go lower, longer dated treasuries today actually went higher as they're expected to remain under pressure after Trump's one big beautiful bill was signed into law. The bill was the centerpiece of his second term agenda, which extends the tax cuts and adds an estimated $3.4 trillion to U.S. deficits over the next decade. So while we're seeing in front end of the curve it pricing in a crisis and tightening financial conditions, investors are looking at the deficit and saying, look, this means that long-term rates must go higher. The problem is what we're seeing in 2-year treasuries and in bill yields indicates that whatever we're seeing in the long bond is about to reverse, and soon. Let's take a look at 2-year treasuries against the consumer price index, that shown in red. Because remember, the long bond is a function of growth and inflation expectations. And what you're seeing in 2-year treasuries right now is they believe that inflation is going to come down. You can go back in history, we can see it very clearly that every time you see the yields go down on the 2-year, at some point inflation reverses and heads lower. And right now, everybody believes that tariffs are going to drive prices higher, and they might in the short term. But what we're seeing in the bond market, it is very clear that consumers aren't going to be able to afford those higher prices, and that means we're going to see continued downward pressure on inflation. But what about growth? Let's take a look at what 2-year treasuries say about GDP. And well, it's the same. Where 2-year yields go, inflation goes down and growth goes down. And what that should mean for the long bond is that rates on that should go down as well. Let's take a look here at what 2-year treasury yields still in blue against 30-year yields in red. Again, right now the market's saying very clearly, look, we think that 30 years need to go higher despite what the facts happening in 2-year yields. But again, 2-year yields, when they go down, it brings the entire curve with it. So it's very clear what we're seeing is financial conditions tighten. When that starts to happen, it means growth and inflation expectations are going to turn to the downside. As it becomes clear that the economy is slowing down and potentially heading into recession, or even worse, a financial crisis, you're going to see interest rates on the long end of the curve come tumbling right down with it. And the sustainability of the U.S. debt trajectory will start to be questioned, but again, it doesn't matter. It's never mattered. More and more investors will try to hedge or to diversify away, slowly but surely, from the U.S. dollar. And this is baffling to me as well, because when financial conditions tighten, people sell their risk assets, and what do they want to hold? They want to hold dollars. And so when we take a look at this next chart, and you start to understand what's going on with the banks, they see a financial crisis is coming. They're tightening lending standards. The bond market is reacting correctly to exactly what the banks are doing and what's happening in the economy, and yet everybody thinks the dollar is likely to weaken. Well, let's take a look back in history. What do we see around 2009? You see the 2-year treasuries plunging and the dollar takes off. You see it happen right around 2019 as the Fed's cutting rates, 2-year yields go down, the dollar goes higher. And right now, again, the consensus view is the dollar is going to continue to weaken. I said on the Sunday show, I think this could be the biggest trade in the second half of the year, and that is long the dollar. And based on what we're seeing in 2-year Treasury yields, the dollar could find a bottom here pretty soon and potentially go screaming higher on a breakdown of yield. But many people, again, like the media, say it's all about the trade war. Let's turn to Lutnick today, who says Trump's tariffs will now take effect on August 1st. We're seeing letters go out. I think we'll have most countries done by July 9th, either a letter or a deal, Trump told reporters on Sunday. Some of those letters are going to go out on Tuesday. And while the media is looking at this and saying, look, what's happening in the bond market has everything to do with the trade war, what it really has to do with the fact is the U.S. economy is slowing down. And based on what the bond market is saying, not only about the trade war, but the tax package and the labor reports, is that things are likely to continue to get worse. And so you start to look at the banks and what they're doing here. While their investment analysts are talking the market up, the banks underneath are out buying bills and notes in a major way. Again, they're buying them at yields underneath the overnight federal funds rate. And there's a really good reason why. Let's show you this next slide, and it'll drive the whole point home. Let's take a look at what happens to the labor market when 2-year Treasury yields go down, and it's all about average weekly hours of production of non-supervisory employees, because what came out on the non-farm payroll report is there was a huge decline in hours. And what we know is as the economy slows down, that's going to get even worse. And we look back to somewhat like the University of Michigan sentiment survey, and we started to question, why was there such a decline in sentiment? At the same time, what did we see? An increase in hours. But workers knew what was coming. They knew that wasn't going to last. We saw hours plummet. What we're seeing is paychecks shrink relative to inflation. And what we're seeing in the bond market is reacting to exactly what's going on in the economy. Let's take a look what happened going back into the dot-com bubble. You see weekly hours went down, 2-year bill yields went right along with it. Happened going into the financial crisis, happened going into the pandemic, and look what's happening now. The reason you see the 2-year yields went up around 2021 had everything to do with the Fed and not the fact that hours were coming down, but look what's happened since. Hours work continue to decline. Bill yields are falling. What it's telling us, again, financial conditions are tightening. Workers have too much debt. They don't have enough income. They can't afford higher prices, and it means they're not going to be able to pay on all their debts. So you start to have a very clear picture of what the banks are doing. They know what's going on. They see the economy slowing down. They see all the signs of a financial crisis brewing. They know that workers are not in a great place and likely to be in a far worse place going forward. So what that means, they're buying bills and notes, and they're buying them in a big way. And again, this is exactly what happened ahead of every last recession and financial crisis. So now you know what the banks are up to and why they're doing it. And this is a major red flag for the economy as we go forward. If something doesn't change and fast, well, watch out. If bill yields come crashing down, it's a foregone conclusion of where the economy is about to go. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.